Good afternoon. We are Hyperion Investments, and it is our pleasure to present our analysis of the Manila Electric Company, or Meralco. Meralco is the largest power distribution company in the Philippines, accounting for 55% of energy sales in the country. It holds an exclusive right to distribute electricity in its franchise area, where 46% of the country's GDP is produced. Using a discounted free cash flow method, we arrive at our one-year target price of 397 pesos and 40 centavos, offering a 43% upside from its closing price on November 29, 2013. In the next few minutes, we will be presenting Meralco's highly defensive core distribution business, its promising investments in power generation, and the company's solid financials led to our strong buy recommendation. Now, the Philippine power industry is composed of four sectors: generation, transmission, supply, and distribution. Under EPERA, both generation and supply are competitive, while transmission and distribution are regulated and are awarded through congressional franchise. A transmission company is not allowed to engage in any other sector of the power industry, while a distribution utility may participate in both supply and power generation. Meralco's main business is in power distribution.
As a distribution utility firm, Meralco operates a highly defensive business. It earns revenues through wheeling charges for the use of its distribution lines. It's a virtual monopoly in its franchise area, which includes Metro Manila and other parts of Luzon. Its tariff rate, called the MAP, is computed based on the PBR scheme. This allows for the recovery of approved capital expenditures and operating expenses plus a return on capital in the form of the regulatory WACC. The MAP is reset every regulatory period and is adjusted every year for market risks such as inflation and foreign currency fluctuations. Historically, Meralco's distribution business had strong operating results. From 2009 to 2012, distribution wheeling revenues increased by 22%, while operating income grew by 36%. It consistently generated strong operating cash flows, reaching 36 billion in 2012. With this, Meralco's current ratio improved from 1.03 to 1.55 over the same period, while its debt-to-equity ratio remained stable. This provided the financial flexibility to pursue other promising investments, which we'll discuss later. We expect the solid performance of the distribution business to continue in the future. Energy demand is expected to increase, driven by the growing Philippine economy. As of the third quarter of 2013, the GDP grew by 7.3% year-to-date, the highest in Southeast Asia and rivals that of China. With the forecasted growth in energy demand, we expect energy sales volume of Meralco to increase by 4% up to 2019. Using the PBR scheme, we forecasted the MAP for each year in the next regulatory period. Due to a lower regulatory WACC, the tariff rate of 1.63 will decline by 20% to 1.3 in 2016. However, rates will increase, reaching 1.5 in 2019 due to inflation and performance incentives. As a result, revenues will pick up by 2017. This translates to cash flows recovering from the sharp decline and exceeding previous levels at 39 billion in 2019. To value Meralco's distribution business, we used discounted free cash flow to firm method. Cash flows were discounted using a WACC of 10.8%, arriving at the equity value of 299 pesos and 20 centavos. To strengthen the core distribution business, Meralco participated in the initial rollout of retail competition and open access. We expect the profit contribution of our COA to exceed 1 billion by 2018. This will add another 7 pesos and 8 centavos, bringing up the value of the distribution business to 307 pesos.
While Meralco's power distribution business is financially rewarding, the opportunities in power generation cannot be ignored. This allows the company to meet market demand, minimize dependence on current suppliers, and enhance its growth and profitability. In line with increased economic activity, the DOE estimated electricity demand to grow by 4.5% annually until 2030. However, existing power plant facilities across the Philippines will not be able to support this growth by 2016. In 2019, only 86% of total demand for electricity in Luzon alone will be met by existing supply. Through its wholly owned subsidiary MGen, Meralco plans to develop a portfolio of up to 3,000 megawatts in Luzon by 2020. MGen acquired interests in RP Energy and Quezon Power 2, which will account for 17% of this planned portfolio. Similarly, the company diversified geographically by acquiring existing power plants in the Visayas and in Singapore. By the end of this year, we expect these plants to provide a 760 million income contribution to Meralco. Local plants will provide net profit margins of 19 to 22% and ROEs of 19 to 26%. In 2019, a year after all power plants are operational, we expect a total income contribution of 6.1 billion from Meralco's power generation business. The equity value of the generation business was computed based on forecasted cash flows of each power plant. These were discounted using their respective cost of capital, which reflect their individual risk profiles. We arrived at the equity value of Meralco's power generation business of 90 pesos and 40 centavos.
The strong performance of the power distribution business will be complemented by the power generation business. This will result in consolidated profits of 29 billion and operating cash flows of 43 billion in 2019. Meralco's financial flexibility is also expected to continue, with its consolidated debt-to-equity of 0.5 and current ratio of 2.17 by 2019. With its highly defensive core distribution business, promising investments in the power generation, and the company's solid financials, Meralco is poised to maximize the growth opportunities in the power industry. Summing up the values of Meralco's investments in each sector, we realize a target price of 397 pesos and 40 centavos. This offers a 43% upside over its price of 278 pesos and supports our buy recommendation. To complement our DCF valuation, we have conducted a price multiple analysis among Meralco's regional peers. China Light and Power and Power Asset Holdings of Hong Kong are closely comparable since the other utilities are state-owned. Meralco's PE ratio of 16.3 times has been historically higher compared to its peers, but this can be justified by its relatively lower price-earnings growth ratio of 0.74 times. An analysis of its EV to EBITDA reveals that Meralco has been trading at a discount. Moreover, its dividend yield is comparable to its peers, and even higher than the yields of most of the government securities in the Philippines, therefore reinforcing our bullish outlook.
We have identified major risk exposures based on their impact and likelihood and analyzed how the company mitigates them. We also subjected our target price to a stress test, assuming that each risk materializes. Regulatory risks have the highest probability and the biggest impact to Meralco. More stringent rate restrictions can lead to a lower MAP. The company's strategy to continually consult with the ERC even prior to the actual rate rebasing exercise minimizes the adverse effects of this risk. Based on our analysis, the current MAP of 1.63 would have to drop to 1.06 in 2016, a 36% decline for us to change our buy recommendation to a hold. Environmental issues of RP Energy could result in a delay of plant commissioning. The company's strategy to invest in environmentally friendly technology and full compliance with environmental requirements mitigates this risk. The inability to source coal poses a supply risk for Meralco's plants. But as mandated by the ERC, coal plants are required to maintain a minimum of 3 months' worth of coal inventory. Long-term contracts with various suppliers of coal to be negotiated by the company will also help ensure the stability of supply. Meralco's congressional franchise is set to expire by 2028. Meralco has historically been the sole distributor in its franchise area, and its strong track record reinforces franchise renewal. In closing, Meralco is grounded on its highly defensive core distribution business with promising investments in power generation. It has solid financials and is highly resilient in the face of various risks. Ladies and gentlemen, with our valuation of 397 pesos and 40 centavos offering a 43% upside, we recommend a buy rating as Meralco continues lighting the way.